Hey guys, welcome to Tickzon, where we try to turn our hindsight into your foresight. Welcome to the video. Ugo here, and I hope you are having a blessed day. Now, I apologize because I did say that this video was going to come a little bit earlier in this week, but unfortunately life does what life does and changes your plans. So make sure your plans are always adaptable and able to be dynamic against life, because life just be doing as it do. But straight back to the video. A subscriber was asking, what is the difference between... Oh, that felt good. What's the difference between index fund and ETFs? Okay, cool. So in this video, we're going to explain the difference between index funds, ETFs, and what they are. And then I'll do a little hint bonus on what mutual funds are towards the end of the video. But ultimately, at this juncture, hit the like, subscribe, hit the notification bell as well. So you know, listen, we're dropping a lot of value here. That's what we do. If you feel like this is not valuable to you, please hit the dislike button, provided you were here to understand what index funds and ETFs, then do that. But look, I'm gonna use Skittles to help me explain what index funds are to you. So, without further ado, I'm gonna bring you closer to my table. Before we get to the table for the illustration, remember, I'm not a financial advisor. And even if I was a financial advisor, I'm not your financial advisor. So if you need a financial advisor, go and seek a qualified financial advisor to deal with your unique situation. So we've got a bunch of Skittles here. I've emptied out a pack onto the table. Ooh, another one. And so when it comes to the stock market, we're investing in a lot of individual companies. And so I know some of you man like the greens out here. So let me try and arrange it. We've got the greens out here. We've got the oranges out here. And we got the yellows and the purples, so on and so forth. Now, when it comes to the stock market, now when you're picking individual stocks, it's like you saying, okay, I only want green Skittles, and let's say in this particular instance, the green Skittles are going to be Amazon. Let's say the green ones is Amazon. Let's zoom out to get that correctly. So the green ones are Amazon. Let's say this is Tesla, this is Facebook, Unilever, whatever. But you are choosing individual stocks. Now, obviously, it is long for a lot of people to pick an individual stock, So basically, instead of you buying just Amazon, Apple, etc., and you buying 5 shares here, 10 shares here, whatever. Now these guys might go up, these guys might go down. These guys might go up, these guys might go down, you never know. So instead of you picking individual funds, there's a way for you to actually invest in all of them by only buying one fund, and that is buying the whole packet of Skittles. So essentially, by buying one share of an index fund, you're basically buying the whole packet. Now, in each packet, as you can see, there's less greens here, there's whatever. Now, in each packet, there can be a different distribution of what companies are actually in there. So even though they may all be Skittles, because they're all index funds, they may have different compositions, and then that comes down to the weighting. So within each index fund, there's a different weighting, and there's a different number of holdings in there. Now, for example, they have the S&P 500. So there's the Standard & Poor 500, which is basically the top 500 companies in America. And those are within the stock market. So when you buy one index fund, it's almost like you are buying one packet of Skittles, and then you can invest. You're basically buying a piece of every single company in there. Now, within the index, the S&P 500, with as well as other index funds, they're not all weighted equally. So it includes all top 500. Actually, it's about 503 or 502 companies, and that basically, because it's the top 500 companies publicly traded in the U.S. stock market, it technically represents to some extent the top 500 companies in America and almost the American economy. That's the reason why when you buy an index such as the S&P 500, it's almost like you're buying into, or you're basically betting on the strength of the American market. It's never provided a negative it's never provided a negative return in a 30-year period. So basically, buying an index fund is by buying a packet of Skittles. Okay, so now we've done the index fund. Obviously, the index fund is basically a collection of companies which tracks a certain index. So S&P 500, top 500 companies in the US stock market, FTSE 100 or FTSE 250, respectively top 100, top 250 in the UK stock market. Now, the difference between an index fund and an ETF is that they're essentially somewhat the same thing, okay? But with a few caveats. So, if you imagine we're at school, I got the Skittles, and basically, or you can think of it as Skittles in terms of this is the index fund, yeah? And so an index fund, the difference is that you can only buy and sell an index fund once a day. And typically index funds, you can only buy them directly by the index fund provider. So if you want a Vanguard index fund, you'll normally be able to get that from Vanguard's platform directly. Fidelity, iShares, so on and so forth. So, and basically it's like I'm going to school. So let's say me and my friend are in school and we keep on swapping Skittles. So I give him this Skittles to give him back because I want to sell it. He buys it from me, and then afterwards I want to buy more Skittles, I buy it back. So I can only buy it in the first period of school, in the beginning of school, and then at the end of school. I can only buy and sell once a day, and then I won't be able to do it until I see him in school the next day, and I can't do it on weekends. That's what index funds are. Now, when it comes to ETFs, ETFs are like I'm living with my brother, and we can trade this as many times as we want. I'll give him this one, he can give me that two, and we keep going, because when an ETF is an exchange tracker fund, an exchange traded fund, etc. I'll put the correct name there because I'm a bit discombobulated. I'm thinking about eating some Skittles here. But basically, it can be traded like stocks. So basically, you can buy this in the stock market. So the index fund you see on the stock market, whether it's FUSA or whatever, that's the ETF, because it can be bought and sold as many times as if it's a stock, but you're basically buying into an index fund. Now, index funds always have fees associated to them. For example, the Vanguard index funds is about 0.04, but with an ETF, that is charged at point of when you buy it or when you sell it. So it's already incorporated into the ETF charge when you buy it off the stock market, and when you sell it, the charge is automatically taken out there from there. You don't have to worry about that. Now, obviously, when it comes to the index fund, you see the fees there, they'll charge you, they'll deduct it, whereas on ETFs it's already included in when you buy the stocks or shares. Now, another big difference between them is that when it comes to index funds, when you go to the platforms, etc., they will also do what they call DRIP, so dividend reinvestment plan. So basically, whenever you get dividends, they'll automatically buy more shares for you on no extra charge. Whereas if you do it via ETF, they pay out the dividend to you on a quarterly or monthly thing, and then you have to buy it back directly. So that's basically the difference between the ETF and the index fund. Now, it depends on, the index fund can sometimes depend on their pros and cons. So index funds, obviously, you're buying directly from the institutions. Most of these institutions are long-standing, and so in that sense, and because you can only buy once a day, it doesn't allow you to do day trading with the index funds. It's for long-term investing, etc., etc. And obviously, the dividend reinvestment plan is there. Now, ETFs, obviously, you can buy as you want, and obviously, yeah, you can buy as you want, you can sell whenever you want, as opposed to being restricted to buy and sell within a day. So if you're a short-term buyer in terms of an index fund, probably ETF is better. But obviously, depending on the platform you're using, if it's like an app, it may not be the most long-standing with historical ties that that it will be here in 20 years, 30 years time, as opposed to Vanguard. That Vanguard has been here for the last 40, 30 years, 50 years, so it'll probably still be here in the next 50 years. I'm on Trading 212. Is that going to be here in 50 years? I don't know. I might consider moving my money onto another brokerage. We'll see how that goes. But obviously with ETF, it provides ease of access for your money as opposed to the index fund. And then ultimately, it just, it's the dividend reinvestment. It's weird to go and buy 26p worth of share, but with fractional shares being allowed in these funds, it is typically easy to do that. Now, as a bonus kind of level, so ETFs basically acts like stocks. You can buy and sell anytime. Index fund, you go directly to the platform. With both of them, you can use your stocks and shares ISA to do that in most of these guys who provide funds. So I know Vanguard does. I'm not sure about iShares. I know that Fidelity does, but you can do the stocks and shares ISA. Remember, you can only have one stocks and shares ISA. So for me, at the moment, I am using Trading 212, and I am buying ETFs just because, and at this juncture, I want my index funds investing to be in a stocks shares ISA, but I also want the ability to buy other shares with my stocks and shares ISA, which you won't be able to do if you were to go straight index fund, because you would use it if you were to use your stocks and shares ISA there, then yeah, you can't use it in another platform unless you wait to the next tax year to open a new one, and then you stop contributing to that one, because you can only contribute to one stocks and shares ISA per tax year, but you can open a new one each one, provided you're not going to try and open another one. Obviously, you can go the backhanded route, the low key of if you're in this platform and you don't like it, you can transfer from one stock shares ISA to another, and it doesn't count as you open a new one, but you have to go and tell the bank or the investment platform you're going to transfer it for you. Now, as a bonus, mutual funds, which is another one that people put into this fray when they're talking about mutual funds, is kind of like an index fund, but it's a custom one. So basically, it's like if you buy into a company. So if you were to buy into Tickzon Mentorship Scheme, you will get a piece of anybody anywhere we're invested in, as opposed to what is tracking an index. So obviously, whether it's clean energy, EV market, whatever, there's an index created that all these ETFs, all these index funds follow. So if it's top 500 companies, top 200, those ones within their own industry, and people can make their own ETFs. Companies are making their own ETFs like ARK, BlackRock, Vanguard, all of that. And so you see the weighting, they're tracking something. Whereas a mutual fund is like, okay, if you buy into this company, they're invested in Apple, they're invested in my guy down the street, and you get a piece of everything they're invested in. Now, obviously, investing comes with risk. There's no guarantee you make money, but for 99% of you, slow and steady growth of just putting it into an index fund or to an ETF is probably the best guarantee for you to generate wealth, as opposed to be chasing the quick returns of going to flip stocks every day. Now, obviously, if you're willing to do the research and go and find out what it's about, then, research the stocks and then go into it, or follow, what other people don't really follow what other people are doing unless you've researched. They only invest in things that and only put in the amount of money you're willing to lose. Now, obviously, as a little quid pro, English is not working, but basically, when it comes to stock market, I know over the past couple of days, people are asking me, yo bro, the stock market's going down, what's happening? Me, I don't know. But the first thing you do whenever you see the stock market going down is what? You check the news, you check Wagwan. The stock market is emotional. The best time to actually buy, if you believe in the company, is on red days. So market crash last year was the best time to buy companies. When everyone's selling off, be greedy when everyone is fearful, and be fearful when everyone's greedy. The time to sell off is when it's green, when it is up. But most people hold when it's green, and most people start to sell off because they're scared when it's red, and they see it bounce back, and they're annoyed and they're pissed, and that's what it is. So this has been not too much, not so much of a quick video, but basically trying to illustrate that, a mutual fund is a custom kind of one. You buy into a skills company, so you get a bit of Mars, you get into a bit of whatever. I don't think they're for the same company, but you get what I'm trying to say. It's like, whereas an index fund is basically buying a box of celebrations and getting a piece of everything. And then an ETF means that you can buy celebrations anytime in the day and sell it anytime in the day, and all the fees are included in the ETF. While on the index funds, you see the fees there. So it's been a good day so far. Hope it continues being a good day, and hope it continues being a good day for you. Hit the like, subscribe. If you have any questions, let us know. This has been a long video, but I hope the whole Skittles helped you understand what we're trying to talk about. So have a blessed day. Bye.